Hey everyone, and welcome to this week's On the Spot, where we discuss the most recent happenings in the freight market during the week. I'm Zach Strickland, Director of Freight Market Intelligence here at FreightWaves, and with me as always, John Paul Hampstead, Director of Passport Research. JP,
hey,
welcome.
Good to see you again.
Yeah.
Last week was Kevin, but it's been more of the same. The freight market continues to turn hotter and tighter. It's been, I don't know, what have you been hearing? I mean, there's the national tender rejection rate is 20.
It's up around 23%.
23.9%.
Yeah, 23%, 23 to 24% right now. Tender reject. I guess the real big story this week is the fact that we continue to see the market grow. We're seeing volumes increase. We're seeing tender rejections increase. It took a kind of a step back last week on the tender rejection rate, but the volumes continue. They didn't stumble at all. The volumes in the United States continue to grow, and I think that kept some of that pressure on the market. And carriers right now are really having to decide which accounts they're gonna service.
That's right. I had a conversation with the CEO of a top 25 freight brokerage earlier this week, who said that the market right now is really stressful for freight brokers. They know that what they're doing, if they've got a lot of freight moving at contracted rates, that it's not sustainable. They can't create margin at all without diving into the lowest quality carriers, and then you've got service issues and lots more manual work at a time when they're working from home. They've already got like more loads per person on their boards than they know what to do with, and they can't really afford to do that. So they're essentially losing money on contracted freight. They can't keep that up, and the decision is, basically boils down to which accounts are we willing to churn to make money.
Yeah.
And how long do we think this rally is going to last?
I think that's the big question on everybody's mind at this point, because we, obviously a very volatile year in 2020, and we had the lowest historical tender rejection rate just a few short months ago, and now we're all the way back up to a 2018 style rejection rate. Not the highest of all time, mind you, but that's an extreme volatility that is very difficult to manage for brokers, carriers, and shippers, obviously, to an extent. And I think you're making a good point on the contracted business for a broker. They don't control the assets. So
they don't control their costs.
It's much more difficult for them to control their costs unless they go and find low-cost carriers across the board. Maybe they can manage some of those relationships. And again, the transition from a low volatility market in 2019 to a high volatility market is really what makes it more difficult, because say they go out last year, they're getting the contracted business, they're growing their managed trans side of the business, feel really confident in it, and then 2020 comes along and just wrecks all of that.
Right, and that was really the hard part, was that in 17 and 18 there was plenty of spot business to go around, and you had a lot of growth. A lot of traditional freight brokers were able to post really robust growth on spot business. In 2019, a lot of people had to pivot, grow their contracted accounts. And the way they did that was by bidding very aggressively. And this was sort of before some of the price rationalization took place on the digital broker side as well. So you often had people like Robinson, Uber Freight, Convoy, and some of the other freight brokerages with a lot of capital behind them, really driving down contracted rates in an attempt to get volumes. Right. Now that playbook does not work at all. And so there are brokers who are really committed to their customers and trying to take care of them and service the freight that they said they would, and they're suffering and paying. Right.
Right.
I mean, there are the majority of other 3PLs are just having to make very tough decisions about. They're talking to their business intelligence analysts. They're looking at as much data as they can, which is obviously, it's a difficult time to do that because there's so much confusion in the market.
Right. Well, this right here, I think, is a good, kind of lesson to take away from this market is, say you're a broker and you've gone to this contracted freight side, you're a shipper, you took advantage of a very soft market in 2019 to contract back some of, the Cass line haul index actually shows that some of those contracted accounts actually pulled back some of their increases from 2018. And so, it doesn't always pay off to be the low cost, or the low end shipper or the low end broker. If you beat your rates all the way down to the low end just to win, the lowest cost provider, like you really set yourself up for situations like this.
Yeah.
Not a lot of people could have predicted what has just occurred in the market. I don't think that anybody really ever would have called for it.
And I think when you're a shipper, it matters, what kind of commodity you are moving, how valuable it is,
right,
what kind of inventory levels you can sustain, and therefore like how volatile your seasonal demand is. You know what I mean? Like if
Sure.
you can, if you're a structural steel manufacturer, right, and you move things and it sits in a yard for a long time before it goes to things
Right.
like that. Like there's no rush, right? If you're a retailer, you have to get your product in front of people in order to, get to earn revenue, and so you don't have much choice about when you want to move things.
Right. So I think, the market itself, we've seen things continue to grow in most of the major markets. We took a little breather last week. The rejection rates kind of settled a little bit in some of the larger markets, not so much in the smaller markets. But this week, again, Los Angeles and
Yep.
Southern California take another big push at volumes, outbound volumes. And again, a lot of that feels like it comes from the
ocean side. It definitely is on the ocean side. We're seeing just incredible strength on imports. July was the first month of positive growth for TEU volumes for
Right.
West Coast ports in more than a year, and that number is that trend is basically going straight up.
Mm-hmm.
Meanwhile, the railroads are struggling to deal with contracted customers. PSR is about cutting fat from your operation. I feel like Union Pacific cut into a little bit of bone, right? And now they're adding back power and crews, but on a lag to volumes. And they've essentially told customers that they're not accepting spot volumes. They did that by raising rates, by over $1,000 a box out of California. And so there's the intermodal safety valve is not a safety valve anymore, right? And so what we've seen is more and more capacity gets sucked into LA, which is actually interestingly having the effect of ratcheting Dallas even tighter. So Dallas's tender rejection rate is above 27%.
Yep.
That's actually tighter than LA because what the rails are doing plus what the imports are doing is pulling so many trucks into LA that like now Dallas doesn't have enough trucks. Chicago is rejecting more than 14%. Atlanta is rejecting 22%.
A lot of what I've heard over the last couple of weeks is stories about how carriers are actually, we saw this in 2017 with the big produce rush and obviously increased freight demand. But you don't realize that as carriers are trying to get to places like Los Angeles, they're bypassing Dallas. They're not servicing Atlanta. They're not servicing Phoenix. There's all sorts of these bypasses because they're trying to get to the best paying freight that they can service. And when you're talking about produce season and produce shipments, the reason that they do bypass all of these, Dallas markets and all that is because they get paid so much more to haul some of this high value freight that's very service centric. So that's what we're seeing right now. We've heard a lot of stories about how carriers are taking, basically even money going from east to west because they're making so much going from west to east right now.
Yeah, and it's not just anecdotes. We also see that in the data. We really like our TCA truckload profitability program data, which gives us a really good view into sort of the middle market, where our tender data is probably, tilted toward larger shippers, larger carriers. truckstop.com data tilted toward brokers and smaller carriers. The TCA data is really in the middle, right, where we've got a couple hundred carriers with a couple hundred power units each, right? Is sort of a general profile. And what we see there in the early data for July, and some of this will kind of return to mean a little bit, but we're seeing an increase in empty miles in the July data that's being reported, and we're seeing a massive increase in driver revenue per week.
And see that kind of contradictory if you're trying to think about it.
Because they're going where the hot freight is.
Right.
They're willing to drive empty a little bit more. So empty mile percentages are now above 15%. They went up almost 100 basis points month over month, and that's simply because they're managing for yield. They are. And they're moving their assets where they can make the most money. Yeah,
this is a common occurrence in carrier pricing. You always price into the head haul, and you price your way out of the back haul. So basically that means that you're going to take, from Seattle to Los Angeles, for instance, you're taking a 130 OR operating ratio to come down, but you're taking a 70 OR to go from LA to Seattle. And the same happens from like Atlanta to Florida and vice versa.
Yep. Yeah, and so it's obvious that the carriers are exercising their optionality. They're being choosy about the freight that they're getting. They're picking the best mix for them, and from what we're hearing, the 3PLs have started to do that as well.
Yeah, so let's look a little bit into the future. I mean, we talked about how the ocean freight really doesn't show any sign of slowing down. This is not going to sustain at this level. I don't think anybody thinks that we're going to see, tender volume index going above 15K for 6 months by.
No.
It is 2020, so maybe I'm wrong on that. But for now, looking into the near-term future, we're looking at our ocean shipments, which is bookings for things coming across the water into the United States over the next couple of weeks. There's no sign of slowing right now. And it looks like, import volumes, of course, coming into LA. The East Coast is finally starting to see significant increases on that end. Savannah,
and those bookings,
New York.
Zach, can you tell us a little bit about the lead time for those? So when is it booked versus when the container gets put on the boat versus when it hits the West Coast port?
So when we talk about bookings, this is stuff with estimated time of departure dates. So we have a week ahead view. So for the next 7 days, we're showing 120% year-over-year increases in shippers saying we're scheduling containers moving from China or wherever to the United States. So they haven't yet gotten on the water yet. So the next 7 days still showing significant increases year over year. And then you have another 2 to 3 weeks before that stuff, say it's coming from China, 2 to 3 weeks before it hits Los Angeles and Seattle and ports like that. Then you have to add another week or two before it can get to the East Coast as well.
Yeah, it seems like the moves by some of the container ship lines sort of signaled their confidence in Trans-Pacific volumes. So Mediterranean Shipping Company kind of went outside of the 2M alliance that it has with Maersk to open up a new service called Santana. That's going to be from, it's a Trans-Pacific service, but they're adding that in later this month. And so that's kind of like, they're basically taking that on by themselves, just I think trying to utilize their assets and make some money in this very hot ocean market right now.
Yeah, and the rates are going sky high. Greg Miller wrote a great piece. I want to say it was a week and a half ago talking about that. And then of course we just had record volumes in the port of Los Angeles. For July.
Right.
So, and this is all happening, as our domestic industrial market is just now starting to get going. So
when you think about it, seven days out, 3 weeks, that's a month, right? So hitting the port 120% up a month from now, that puts us in late September, right? So that pretty much carries us into peak.
Yep.
So I think it's safe to say that we believe that demand for trucking transportation in the U.S. will be strong through the rest of this year.
More than likely, yeah, because this is the peak season for the ocean side. Then we've got retail season. God knows what that's going to look like this year in terms of consumer demand. So
Right.
Still a long way to go and a lot to discover as this moves forward. And of course, that'll wrap up our show this week. JP, thank you as always. And thank you, of course, for watching. And be sure to check out FreightWaves.com for any future freight market updates and see what happens next. Have a great week.